All right, let's get started. Welcome, everyone. Thank you for joining us today. My name is Nicole Fortine. I'm the head of customer success at Verivest. And today we're going to have a discussion on what you can do to streamline for tax prep all year long. But let me introduce my first guest, Amanda Martin. She's the VP of Accounting at Verivest. Hi, Amanda. Welcome.
Hi,
Can you
thank you.
can you introduce yourself and a little bit of your background?
Yeah, so I am Amanda Martin. I am the VP of Accounting here at Verivest. I have over 9 years of experience in the fund admin industry, and I've been with the company for 9 years as well. Um, we specialize in the real estate space, so that is what my fund administration background is in, and I am a licensed CPA in the state of Montana.
Thanks, Amanda. Amanda, like she said, has been here for a really long time, so she knows our business and our customers very well. So we're excited that you're here. She's a great resource. And then our next guest is Tyler Desmarais, and he's the VP of Tax at Verivest. And excitingly, he's welcoming a new baby into his family. So we have pre-recorded his session, so you'll get his introduction and the bulk of this webinar in just a moment. But let's go over the agenda first. All right. So first, we'll cover tax season basics, the timeline of events, ensuring efficiency from a tax CPA, year-round tax analysis and strategies that you can implement, tax law changes, and then finally we'll go over Q&A. You don't have to wait till the end. Just a reminder, we always want you to ask questions throughout the session. We'll answer them at the end, but we want to engage with you on these topics. So feel free to jump in at any time, and you can use the Q&A box at the bottom of your screen to ask questions. All right, with that, we'll dive into our session with Tyler. Right, now I'm going to introduce my next guest, Tyler Desmarais. He's our VP of Tax. Tyler, can you tell us a little bit about your background?
Sure. I'm Tyler Desmarais. I am the VP of Tax here at Fairway America and Verivest. I've been in partnership tax for the majority of my career. Spent several years at Moss Adams and several years at Grant Thornton, respectively. So essentially, fund and real estate taxation is just what I focus on now. So that's what I do.
All right, thank you for that. Okay, so now Tyler is going to share his insights on just how to streamline your tax prep all year long. But just want to remind you that you can ask questions at any time by dropping your questions in the chat at the bottom of your screen. All right, Tyler.
Awesome. Yeah. So first, I wanted to kind of start off at a really high level. Start with what tax season is, what it looks like for a typical fund manager. So go ahead and go to the next slide. So typically speaking, funds are set up in a partnership form for tax purposes, whether it be an LLC or limited partnership. These are taxes passed through entities for federal income tax purposes. Typically speaking, partnerships are required to file a Form 1065 annually. This shows the partnership's activities throughout the year. And then at the end, we'll distribute out a K1 to show the ratable amounts of income and loss, along with other partnership attributes to the investors. The initial filing deadline for a calendar year partnership is 3.5 months after the year end. Which means that for 2024 tax year, the deadline is March 17th, 2025. That being because the 15th is falling on a weekend. Albeit March 17th is St. Patrick's Day. It's not a federally observed holiday, so you don't get that free day. The federal extension for partnerships is a 6-month extension to the filing date, and it's only for the filing. It is not an extension for tax payment. So for the 2024 tax year, the deadline for the extended due date is September 15th, 2025. So this could stretch out your tax season significantly, and I'll kind of go through that in the slides as we move forward. Some of these funds may be set up as a real estate investment trust. I know that that's become more in vogue lately. Real estate investment trust, without going into much detail, are an entity type that requires at least 75% of the assets being qualified real estate or mortgages. And it is also required to distribute 90% of their taxable income to their investors. There's some other strict rules surrounding investor count and beneficial ownership, but for the purposes of these presentations, I won't delve too far into these rules. Calendar year end REITs are generally due 4.5 months after the year end, which means that for the 2024 tax year, the deadline is April 15th, 2025. Similar to the partnerships, there is a 6-month extension to file, which would be for the 2024 tax year will be in October 15th, 2025. Unlike partnerships, REITs typically provide Form 1099 divs, DIV, to their investors for the amount of dividends distributed to them. Typically, these 1099s are due to the investors by January 31st of the next year. So that's kind of the table stakes of what it looks like to kind of operate a fund or REIT during that time period. Now we're just going to go through what I would say a streamlined, efficient manner of a timeline of events for timely filers. So folks that aim to file by that March 15th or April 15th due date, depending on what they are, and look to get that K1 out to their investors, their partnership, by that March 15th due date. So if you could go to the next slide. So typically speaking, around this time of year, October, December, you do your year-end planning. Now, year-end planning can mean a lot of things, but typically speaking, it's for tax purposes. We're looking at any sort of planning opportunities that could be addressed ahead of year end. If these aren't done, they could really cause a delay in your tax prep. You know, if you want to do some of these things and you end up doing it in January or February or March. So typically speaking, I prefer to do it even earlier than this if possible, in the summertime, but October, December totally works. This is typically your down period for your CPAs. So coordinating these projects with them could, in essence, speed up the process for them as they're going through their typical busy season, which is January to April. Planning opportunities consist of, like, for real estate partnerships, real estate funds, cost segregations for your building. Cost segregations are where you parse out disparate parts of the building. So you have the building envelope, but you also could parse out HVAC, flooring, roofing, things like that. And essentially, any of the shorter lived assets that you may have, you can take advantage of the bonus depreciation rules, which will essentially accelerate your depreciation upstream for your owners. Could be a very big benefit depending on your structure. Typically speaking, that's what we take advantage of quite a bit in our real estate funds here. Talk a little bit more about cost segregation on a later slide because there is some nuance to it. 179D and 45L studies. So 179D is an energy efficiency credit for commercial buildings. Also applies to multifamilies that are 4 stories or higher. Could be a pretty nice benefit depending on what type of real estate you do have. 45L is a credit, mostly for energy efficient homes. So that could be taken by developers or builders of these homes. That could also be a pretty meaningful credit for certain types of funds. Obviously, the R&D credit that's been around for a really long time. That is something where you could look at any of these types of research expenditures. And research is a fairly, it's defined, but it is fairly loose in terms of what it could be. So if you have any sort of tech attributes to your business, you may be even able to qualify for this. And this does take a lot of time to analyze the payroll and things like that. So I would recommend, if you do want to go down an R&D credit analysis, you do it early and often. And then a big one here is the state and local tax. That's SALT, nexus studies, apportionment studies, and sales and payroll and property apportionment studies. These tend to take a lot of time, but could reduce your taxable income footprint in various states. You could possibly get to a situation where You lower your nexus, you lower your sourced income to high tax jurisdictions, and you could put them into essentially nowhere states where you reduce your state tax liability by a significant amount. So it could be a very nice benefit if you do plan around that well. And then some more table stake items to do during year-end planning. So it essentially just ensuring that your retained earnings roll. This may sound really stupid to some CPAs or accountants, someone that has some experience here, but just making sure that your retained earnings account rolls from year over year, that could save a ton of time in terms of what the CPA does on the tax prep side, because that is one of the first things they will look at. They'll make sure that the capital accounts look good and roll in a manner that makes sense. And then the last item is making sure that you make estimated tax payments if necessary. So federal partnerships aren't taxed at the federal level because the income and losses go through to the owners. But for state purposes, state and local payments may be due for estimates and withholdings and things like that. So understanding when those are due and when you pay those could be important. So that's kind of what you would look to do towards the year end. And this is going to be the same for timely filers or extended filers for the most part. You just want to make sure that you have your I's dotted and your T's crossed. When it comes to January, this is when your financial activity for the year really gets buttoned up, and your fund administration team should be helping hone this in. So I'm going to go ahead and pass this off to Amanda, and she could talk a little bit about what it looks like to do some of these steps here. Amanda?
Yeah, thank you, Tyler. Yeah, so January is the start of the year end closing. So the items that are to note is that 1099 INTs and NECs are due to be filed by January 31st. They're not necessarily due to the IRS at that point in time. For the 1099 NECs, they are, but we do issue them on behalf of you guys. If you guys are choosing to engage us for those services, you should have already received an email from our team. If not, please reach out and we will be happy to have that conversation. In order for us to do that, we do need to receive the W-9s for the vendors who are applicable. We will be providing a list to you guys as well for any that we do not have, so you guys can start to gather those from your vendors. And it's just best practice to be gathering those throughout the year as you're making payments to help ease, since January tends to be a busy time for everybody, not just the accountants as well. In addition to that, we'll be trying to close the books as soon as possible for you guys. So if you guys can provide us with your cash reporting items as well as all of your non-cash reporting items, that will just help us be able to close that much sooner. The items that we will be providing after we do finalize the books for your guys' entities will be, if we are engaged for the full admin, would be the financials package, which would consist of a balance sheet, profit and loss statement, general ledger, and trial balance in Excel format, as well as a capital account reconciliation file for the investor equity balances that would contain their contributions, any redemptions, income allocations, distributions, to help facilitate the K-9 preparation and tax preparation for your entities. Back to you,
Awesome.
Tyler.
And that's exactly right. And I'll kind of hammer back on what Amanda said, because there's a few important pieces there. Obviously, 1099s are due to recipients at the end of January, so that's a really key one. If you're a REIT, right, the 1099 divs are also due. And then the key item that I'll hammer on later on as well is all the financial information, right? Whether it be P&L, the general ledger, the balance sheet, trial balance, all in Excel. That is an item that I'll highlight later, but I wanted to highlight here because Amanda directly brought it up. So after that, once the fund admin team provides you the financials, and I kind of said late January to early February, This is really contingent on when you get the fund admin team, your annual information. This could, vary drastically, but in this case, this is for the most streamlined, efficient fund manager here. So once you do that, you or the fund admin team with your AOK sends over the financials and the capital account work to the tax CPA. Honestly, to make sure that your K1s are there and available for investors prior to the April 15th deadline, I usually try to aim for early February to be when I provide this information to the CPA. Obviously, they have a ton of tax returns to get through. So in essence, getting your information in the door first, if you guys know what FIFO means, first in, first out, tax accountants work on that, work through that type of procedure. So in essence, getting your information in early is the key. The other part that's I don't know if it's as highlighted as getting in, your information early, is responding timely to any of the inquiries that come back from the CPA. If they have any minor questions, it's a real pain when those tiny pieces of information are what's holding up K1s. So just essentially trying to reduce that back and forth time and making that as quick as possible will really help with timely filing. So after you provide all that information to your CPAs, generally speaking, anywhere from late February to early April, they'll be preparing your return and getting it done. As I noted earlier, the filing deadline for partnerships is middle of March. So you may be asking why early April. Typically speaking, I think it is best practice that you file an extension for federal purposes for partnerships anyways. It's a zero-due extension for federal purposes. Like I said, for states, there may be some tax payments necessary, but this will essentially open up your window for a superseding return if there's any clerical errors or anything like that you notice after the deadline, and will allow you to file that superseding return before the extended deadline. This is a lot better than having to file an administrative request, an AAR, and that process in itself will be expensive, time consuming, and there's a lot of really difficult items that you and your CPA will have to work through to kind of get to that right spot. So like I said, recommend just filing that extension regardless of whether or not you're going to timely file. Then obviously, once you get your return, review, do a high level light reasonableness check on the tax return. Make sure you review all the K1 information. This is something that I just recommend people that don't even have an accounting background to do. Just look at the K1s and make sure like addresses and names are spelled correctly. This is something that obviously your investors will directly get and receive. And if they see that their name is misspelled or something like that, just based off of just some sort of clerical error, it could leave a bad taste in their mouth. So I would recommend that even that high level of a check, it's a nice check to do for your investors. That's kind of where we end up for timely filers. So anywhere from March, April, you could even go into the May timeframe, as long as you provide your K1s to your investors by March, April, you should be in pretty good shape. If you guys go to the next slide, could talk a little bit about the extension filers. So typically speaking, like I said, I recommend everyone to file an extension, but this is in essence talking about folks that are more okay with providing K1s in the summer months. The initial two items really are the same. You do your year-end planning around the same time, October, December. January, you do your close of books, work with your fund admin team to get your financials ready in place. I would still recommend providing your books to the CPA, the Excel format, to your CPAs in the February, March timeframe. This will allow them to start doing the extension prep, make sure that any estimated payments are made as necessary. And also, this is the key caveat that I would put out there, is if you are going to extend and you aren't going to provide the K1s before the April 15th deadline, typically your investors will request that you provide them with a taxable income estimate. This could be a really simple exercise or really difficult exercise depending on the complexity of your fund. So this might be something that you work directly with your tax CPA to do. Figure out the book tax differences and kind of give your investors a best estimate for extension purposes. So once you provide that, this is where you get to late April to early September. It's a pretty wide range. Typically speaking, this is when your tax CPAs free up a little bit for time as well. So your work may be even cheaper if you were able to push it out into this time frame. But you do the same methodology of doing your high-level checks, providing your investors with K-1s, and then eventually filing your tax return. So this is kind of what it looks like for a typical extension filer. If you guys go to the next slide, we could talk about some of the really high-level items that I already kind of touched on, but how to ensure efficiency from your tax CPAs. So, similarly, if you do, like I said before, if you do your tax planning items with your CPA throughout the year, it really does help them in their prep process. They're more in the know of all the extraordinary items and all the weird intricacies that happen throughout the year and are able to better plan their staffing around it. This will allow them to really turn around your tax return hopefully fairly quickly. So that's honestly key number one. And really two, extraordinary items, like if you have a sale of an asset or things like that, relaying that as soon as possible can allow them to even start working before the typical busy season. They could start calculating your gains and items like that throughout the year as that activity happens. So that could really happen during the year-end planning phase if you have all the appropriate pieces of information. Another key item, so number 3, number 1 and 2 are kind of similar, just essentially communicating as much as possible. Number 3 was the one that I talked about earlier, which is related to having all the financial information in a Excel format and getting it to your CPA early as possible. This will, in essence, get them, something that's usable, something that they're used to having. And it will be in a fashion that's ready to work. So this will essentially fast track your work as much as possible. The next item, I don't know if it's really brought forth that much, but and this is like an important item just to highlight. So if your work papers are very consistent or your financial information is very consistent year over year, your tax CPAs do get used to it. So if something changes, or if let's say a chart of account changes throughout the year or year over year, it actually adds work time for your CPA to interpret it and then work with it. So if you do have a chart of accounts change, it's best to relay that to your tax CPA as soon as possible so they could start working through it. This is another thing that you could likely do during your year-end planning if you know what the chart of accounts is going to be. They might be able to input it and import it into their software. And then last item, we kind of already talked about it as well. Ensure you have retained earnings rolls. That's just a real easy item that could just cut down some hours in terms of hours worked for professional fees. So I guess kind of just go into more of if you go to the next slide, going into more of the new items, the uncertainty of the tax world as you may. But with 2025, the tax world is chalking up to be very, very busy and uncertain. There's quite a few significant tax provisions that are expiring from the Tax Cuts and Jobs Act. The ones I want to highlight, there's a large list, more than what I highlighted here in the top 3. But the large ones, namely for the fund managers that would likely impact you and your investors, are the Section 199A deduction. This is for qualified business income. This is expiring as of 2025. Bonus depreciation, as I noted earlier, one of the big things to plan around is cost segregations and timing that. Bonus depreciation is expected to phase out to 40% for 2025 and 20% for 2026, with it being fully sunset after the 2026 tax year. So that's a huge benefit, typically speaking, in the real estate world that we love to see, but is currently phased or slated to phase out. The last item here is the state and local cap for individuals. So this item was for partnerships. So any of the funds that are set up as partnerships, the state and local tax that the individuals were able to utilize on their itemized deductions was initially not capped. Then it became capped with the Tax Cuts and Jobs Act at $10,000. That cap is now expiring. There was items that kind of were worked in at the state level to allow more of the deductibility for tax expense purposes. So a lot of partnerships, in this case, some of your funds may have elected to be entity level taxpayers for that purpose. With that cap expiring, that could have detrimental impacts to what states do for that partnership level tax. So it just very uncertain in terms of how state localities and even local localities will figure out what to do with the federal changes that are coming up in 2025. In addition, as you guys are all aware, 2024 is an election year. And with that, tax law changes, whether Trump or Harris win the office is bound to happen. Now, although that some of the discussion around the tax platforms are still unclear in terms of either candidate's tax policy, items such as rate changes could offer permanent arbitrage for fund managers that do take advantage of it. And there are items such as like the unrealized gain tax that's been floated. I'm a little bit more skeptical that will work in practice, but it could be something that gets explored further. I do believe that items such as bonus depreciation could be extended on both sides, but it's still very unclear in terms of what each candidate will do if they are elected. With that said, that just really hones in back to doing your planning throughout the year with your CPA, because when there is change, there is usually a way to get to a good tax planning opportunity. So with that said, I'll pause. I'll pass it back to Nicole for some Q&A.
Thanks, Tyler. That was a really insightful discussion, and I know that our clients will find value for helping to establish best practices around tax prep. So thank you for that. Right, now we actually can jump into Q&A. So if you have any questions, feel free to drop them. We do have a question that we can go over now. So the question is, what are some key activities fund administrators and accountants can implement quarterly to stay on top of tax reporting?
Yeah, I can take this one. I would say that there are a couple of key components. One of them is around gathering and organizing the necessary documentation early on, such as any transaction records, investment reports, any correspondence to help streamline the year-end reporting. Also, just conducting detailed reviews of financial statements to ensure the accuracy and completeness of the information and addressing any discrepancies promptly. So this would be both internally on the Verivest side with the financial preparation and what our process is, as well as with the fund managers and clients to ensure that accuracy of that, and any discrepancies we can address those and also get anything addressed by the tax CPA to help streamline the actual tax preparation come early 2025. And that also kind of goes into, involving any tax professionals early on in discussions about significant events or potential issues to help optimize any tax outcomes from the onset. And then finally, as what was mentioned throughout the webinar as well, is just starting to gather W-9s from the vendors throughout the year, as it will allow for an easier 1099 NEC filing process. So January is a really busy time for everybody. And so if we can gather as much information throughout the year from vendors, tax CPAs, or accountants, anything like that, then we can just make sure that we have all the information gathered up and can provide that to just help streamline it rather than trying to scramble to find the information.
Okay, this question kind of adds on to that question. So how can integrating tax prep into monthly workflows reduce the year-end tax scramble?
Yeah, so, I'd say updating any financial records and the tax-related data will ensure that the information is accurate and complete throughout the year. Again, this is kind of be some repeat from what was just answered to, but just involving people as soon as possible when something occurs, just so that way, if there's a change in methodology or if there's additional research that needs to happen, that it can be done throughout the year or when it starts to happen rather than trying to do it after the fact. Maintaining a consistent flow of documentation throughout the year makes it easier to compile the necessary records when tax time arrives, which just prevents the chaos from gathering it all at one time. And again, just gathering W-9s throughout the year. We'll hone in on that. Just it makes it a lot simpler to try to find that information.
Yeah, definitely if you can avoid a scramble, you want to, for sure.
Yes, it's never fun for anybody to be doing that.
Okay, we have time for one last question. So it is, what financial documents should fund administrators ensure are readily accessible for a smooth tax filing?
Yeah, I would say that, having updated investor demographics report, and then the capital account reconciliation file, which that file will provide any of the distributions, income allocations, contributions, redemptions, or transfers made during the year. And then the updated investor demographics report would include their TIN, what kind of entity it is, as well as their address, just since that's information that's going to go directly on the K-1. And those are what typically can be provided to the tax CPAs before the period is finalized too, so that way they can get it entered into their systems. The financial statements, which would include, the balance sheet, profit and loss statement, trial balance, and general ledger in the Excel format. That just helps the tax CPAs as well be able to enter into their system and be able to manipulate any data that they need to. The fund tracking file, which provides investment detail to the tax CPAs, and then any tax documents issued to the fund, which can include, but is not limited to, the investment K-1s and 1099s.
Great, thanks, Amanda. Okay, everyone, that's our time for today. So you can always ask questions to me. Can go to the next slide. Yeah, my contact information is here. I'm happy to connect with you on any questions that you may have. You can also follow along and learn more about these topics and about Verivest if you want to visit our website, sign up for our newsletter, or follow us on LinkedIn. And thank you for attending today's webinar. We'll see you on the next one. Bye, everyone.